Welcome back to Finweek Money Matters. Now, the South African consumers are under financial pressure due to higher interest rates, mounting consumer price inflation and low growth in real wages, as well as rising unemployment. A recent study by McKinsey showed that private consumption in the country has grown by only 1.6% in the past year. Joining us in studio to discuss the state of the economy and the outlook for consumers is John Luce, property, household and strategist at FNB. Excuse me. Oh, I lost myself there, didn't I, John?
John just does a lot at FNB,
I think he does.
Just call it economist.
John, tell us a little bit about the consumer. How are we able to survive in the current economic climate?
Well, I think, okay, obviously there's a lot of poor people in this country. That's always the case, and they battle on an ongoing basis. But when it comes to the cycle, things getting worse and getting better, it's something of a slow puncture, I guess, which is fortunate. Mm-hmm. The Reserve Bank has hiked interest rates very slowly, so it's given households more time to adapt than in previous cycles. This is probably the slowest I can ever think or remember. And economic growth, although it's reached pretty much zero now, it's also been slowly subsiding. So it hasn't been a short, sharp shock, say like 2008 perhaps. And so what one has seen in recent years, we've seen various indications of slow adaptation. For instance, in our housing market surveys, we see the percentage of sellers selling in order to upgrade to a more expensive property. That's been slowly declining for about the last 2 years. We now see signs in our surveys of declining levels of maintenance and upgrades. So slowly but surely we're seeing signs in our property market surveys, and if we look at bad debt numbers in the home loans market, at least they're not shooting through the roof. They've risen a little bit in the first quarter, but nothing too seriously. So slowly things are adjusting, and I think that's fortunate. Look, it's unfortunate that we have an economy that really is just not generating growth, but the fortunate thing about these things is so far things have been gradual.
Before we get on to the topic of growth though, John, it does seem to me that we have a slight period of reprieve. We're getting a petrol price decline of about 83 cents, if I'm not mistaken, next week, if you can find petrol, because they're currently on strike. And secondly, with the MPC keeping the rates on hold, for those who are indebted, this is a good time for you to catch up, right?
Yeah, I think so. I mean, what one must also remember is interest rates are still quite low by our historic standards. So, for those who can, use the opportunity to increase your savings rate as much as possible. Use the opportunity to get the debt under control, whatever under control means. And yes, because there are no guarantees going forward. A lot depends on volatile numbers like the rand. Mm-hmm. If the rand were to suddenly deteriorate by a few rand to the dollars, as it does from time to time, that's the reality. Suddenly rate hikes are back on the cards. At the moment, it's looking fairly promising in the near term for rates on hold, but the rand suddenly reintroduces imported inflationary pressures, and that all can change overnight. So one must never sort of, I know people who run from interest rate meeting to interest rate meeting and breathe a sigh of relief every time they stay on hold. Yeah. They hope for a cut or something. We shouldn't really be focused on that. We should be focused on an ongoing basis in improving the state of our finances.
Mm-hmm. Earlier you mentioned the fact that South Africa will be growing at a 0% level this year. Are we going to be able to avoid a recession with this growth rate?
Well, I think when you're down to forecasts, well, ours are 0.2%, the SARB's 0%, IMF 0.1%. When you're down to that level of economic forecast, I mean, and you're never going to be 100% accurate, then it probably makes a recession 50-50 probability type of thing. I think that there's a real strong risk or high risk of recession. If we look at what's happening in the world economy, not great. And, economists can say things are going to turn now. The reality is a lot of global economists have been over-forecasting on the world economy. There's a massive debt burden across the world, which I think is proving to be a drag. And so we're underperforming on growth expectations. And locally, that has been the case as well. I think a lot of forecasters have over-forecasted growth over the past 3-4 years or so. So the risk of recession is very high. And even if we were to stay at zero growth, which is, as good as saying recession, there's still, from this last 4 years or so of slowdown in growth, there's still the retrenchment impact, I believe, got to come through.
Sure.
We saw a year-on-year decline in employment numbers released yesterday. There was the first year-on-year decline in a good few years. And I do unfortunately think that there's more to come because that lags the slowdown in the economy.
So for South African households, how do we interpret this, and or how do we position ourselves so that we minimize any dire financial impact here?
Well, I think already, South African households as a group are moving in the right direction. It's just a question of whether, debatable as to whether it's fast enough. But yes, it is about, I think, lowering, or in a lot of cases, limiting luxury spend.
That's not what Rofhiwa and I want to hear. We still want to do our hair, our nails, and buy shoes.
We have responsibilities, John.
None of us want to hear it. Increase that savings rate, and we have seen early signs of the savings rate starting to pick up, and I think it will pick up some more. But I think more importantly now, there's a lot of advice about, cutting satellite TV or whatever it might be and shopping at, at cheaper places. That's stuff that can be done. But I think where you can what people really must do more often is look at the sources of a lot of ongoing expenditure items. And what do I mean by that? Well, there's two very big drivers of our future monthly, ongoing expenditures. The one is the house, and the other is the car. With it comes a whole lot of maintenance and insurance and rates and tariffs bills and so on. So what we tend to often do is when we, for an aspirant first-time buyer, we think, can I afford the bond repayment? Great, I can afford the bond repayment, let's go.
But you forget about the other costs.
We often don't even plan for interest rate hikes at some, future stage. But apart from that, the value and the size of your house is going to determine the operating and maintenance costs. It's a big driver of that. And suddenly, from buying a small house, whatever small is, versus buying a big house and a more expensive house, your monthly expenditures can be thousands, many thousands more just because of the size and cost of house you buy. Car is the same to a lesser extent. So I think we need to look more closely at the car we drive and the house we buy, and buy there well within our means as a way of limiting future expenditures.
Harsh realities that we have to look into though, John. But thank you so much for your time, as always. That was John Luce, Household and Property Sector Strategist at FNB, giving us his view on the economic outlook for South African consumers. Well, that's how we wrap up the show from our South African perspective. Rofhiwa, clearly a lot of hard thinking and facing realities, which you and I and many other consumers will have to do.
Yeah, we have to cut down on our spending, Gugulethu. We have to cut down.
Exactly. Well, do bear in mind that the Finweek magazine is available on shelves throughout all good retail stores, and you can get up to date on some of the stories we've covered in today's episode. But from Rofhiwa and myself,
it's goodbye.